Good morning, everybody, and welcome to the second day of the Europe Precious Metals Summit Virtual Edition for 2020. My name is Jessica Leventhal, and on behalf of Precious Metals Summit Group, I'm delighted to welcome you to our first keynote presentation of the day, and it's a great pleasure to introduce to you Ronald Peter Stoefferle, who has been speaking at our events for several years, and in a year such as we're having, where it's a very exciting time to be investing in gold in the precious metal space, I can't think of a better speaker to launch the day to put the macroeconomics and other trends in place for us. So we're really looking forward to Ronnie's talk. Just a little bit about Ronnie. He is the managing partner and a fund manager at an investment company based in Liechtenstein called Incrementum AG. The company focuses on asset management and wealth management and is 100% owned by its partners. There, Ronnie manages a fund that invests based on the principles of the Austrian School of Economics. He's well known internationally as a speaker and an author, especially of his annual benchmark reports known as In Gold We Trust, which are highly anticipated and read annually all over the world. It's terrific to see you today, Ronnie. And now I'm going to hand the mic over to you and have a great presentation.
Thank you very much, Jessica. It is a great pleasure, although I have to say I really prefer real meetings, real conferences. So I'm looking forward to my speech, but I also truly look forward to meeting you all in person, hopefully next year, to have coffee, to have a drink, and to break bread together and talk about financial markets and our beloved gold. First of all, I have to say I'm here in Vienna and I didn't sleep too much because Vienna got hit by a horrible terror attack. And it came to my mind the guiding principle of my favorite economist, Ludwig von Mises. He said, "Do not give in to evil, but proceed ever more boldly against it." Or in German, weichen dem Unglück nicht, nein, unverzagt, gehe ihm entgegen. So, talking about gold now, the title of my presentation is All Roads Lead to Gold. And as you know, once a year we write a pretty big report on gold, the annual In Gold We Trust report. And this year's leitmotif was the dawning of a golden decade. And ladies and gentlemen, I have to thank our premium partners because it wouldn't be possible to publish such a massive report, more than 350 pages in German, in English, and also in Mandarin, without the support of our premium partners. We want to make the case, the sober case for gold, what gold does for your portfolio, what adding mining stocks does to your portfolio, not in a gloom and doom way, but really fact-driven, in a thought-provoking way. And we're very, very glad that we're able to reach almost 2 million people with our publications nowadays. And the Wall Street Journal just called it the gold standard of gold research. So many thanks to our premium partners that make it possible to publish this report totally for free. Ladies and gentlemen, I was once reminded that all roads lead to Rome. I went to Rome back in September. My wife and I, we had a fabulous time. We saw the Colosseum without the thousands of tourists. What you can see here is the Vatican. Normally in and around the St. Peter's Cathedral, there are 10,000 of people. But we had the Vatican basically all to ourselves. We are riding the Vespas on empty streets. We were strolling around the city center, and it felt a little bit apocalyptic. Rome was deserted. Shops were vacant. The city felt like it was dying. It lacked the atmosphere, obviously, due to the circumstances. In the world of financial markets, I'm here to tell you that all roads lead to gold. And when I was in Rome, I felt a little bit like attending a gold mining conference 2 or 3 years ago. In the next minutes, I will show you some insights from our In Gold We Trust report and explain the three main triggers of the gold bull market, the three main roads to gold. First of all, inflation. This is the main road to gold, ladies and gentlemen. Secondly, the fact that gold is largely underowned. Investors with deep pockets are starting to travel this road now. And third, this road refers to mining stocks and silver, which is, of course, a bit of a more bumpy and more volatile road, but it is worth traveling. Those of you here today are part of the 0.5% of the people who have assets in gold. And I think you should strengthen your road to gold. Why? Because we are in a stealth gold bull market. And what should you do in the course of a bull market? You should buy the dips. So I'm looking forward to explaining you the main roads to gold now. Sounds good? Great. Let's just get started. The first thing is historic monetary and fiscal stimulus that I want to talk about. Herbert Hoover said, "Blessed are the young, for they shall inherit the national debt." As a father of 3 little daughters, I think that's a bit cynical, but I'm pretty sure that not our politicians will pay the bill for all those stimulus measures. It will be paid via financial repression and higher inflation. And the second quote is, "Monetary policy does not work like a scalpel, but more like a sledgehammer." This is from the fabulous book Lords of Finance that I just reread over the summer. Very, very interesting description of the Great Depression and of central bankers coming out of the hyperinflation. It feels like at the moment we seem to be at the beginning of some sort of a crack-up boom that Ludwig von Mises described. And the biggest difference between the great financial crisis and the COVID crisis is that we're seeing unprecedented monetary and fiscal stimulus. A couple of months ago, we saw this connection between fiscal policy and central bank policy as some sort of a flirt. Over the last couple of weeks, all taboos have been broken, and we're seeing now a real marriage of unlimited QE and basically unprecedented fiscal stimulus. If we have a look at the numbers, they're staggering. You can see M2 growth rates, for example, running roughly at 20% at the moment for the US and even higher in the Eurozone. If we compare that to 2008, 2009, we actually saw a collapse of M2 growth. In the 1970s, a highly inflationary or stagflationary environment, we never went above 15%. Now we're trading above 20%. M2 growth is going exponential. Ladies and gentlemen, everybody is talking about flattening the curve now, but nobody is talking about the exponential curve that we're seeing in our monetary system. Here is M1. And actually, it took the Federal Reserve 80 years to create the first trillion. It took the Federal Reserve 19 years to create the second trillion. It took the Fed 4 years to create the third trillion, 4.7 years for the fourth trillion, and for the fifth trillion, only 4 months. Before the end of the year, we will likely hit $6 trillion. That means that 50% of the money the Federal Reserve has created in all of its 107-year history would be created just in this calendar year. And it's not only monetary policy that is highly aggressive, it is also fiscal policy. What you can see here is federal debt growth quarter on quarter. Those numbers are truly off the charts. So far, we have seen fiscal and monetary stimulus at roughly 33 trillion US dollars. So 33,000 billion US dollars and still counting. Now, the big question, of course, is inflation or deflation, stagflation, hyperinflation, hyperdeflation, lots of flations around. From my point of view, still at the moment, the deflationary pressure is pretty strong. And if we have a look at economic numbers, of course, we are still in the worst recession, depression, whatever, since the Great Depression in the 1930s. But I think that there's many signs already telling us that inflation is around the corner. Just have a look at precious metals prices. Have a look at energy markets. Why is oil trading at $35, even if we're in this pretty negative environment? Where will the price of oil go to if the economy really recovers? Have a look at copper prices, agricultural commodities. I think the market is telling us that inflation is around. Now, of course, if we should see a wave of defaults, and let me get this straight, so far we haven't seen anything yet. If we should get a wave of defaults, this is highly deflationary. Have a look at this chart showing high yield default rates. We're still at pretty low numbers. And I think it is not a very bold call to say that we will go at least to the numbers from 2008, 2009. So this would be highly deflationary, of course. But we should be sure that central banks will do whatever it takes to compensate. And as I've said, governments, but also monetary policy broke lots of taboos this year. And Murray Rothbard, one of my favorite economists, said it pretty aptly. If you have the power to print money, you'll do it. You find reasons for it. You save banks, you save people, whatever. There are a lot of reasons to print. And many taboos have been broken, and pretty radical ideas that we started writing about 4 years ago in our In Gold We Trust report, like MMT, modern monetary theory, or as Dave Rosenberg used to call it, the magical money tree, or the Mugabe Maduro theory of money. Those theories are coming from the periphery into the center. What you can see here is the Google search trends for MMT. And even though I don't agree with her, I think everybody should read the book The Deficit Myth by Stephanie Kelton. Stephanie Kelton could become one of the most important economists out there, especially if Joe Biden should win the election tonight. So I think that radical ideas like MMT, like universal basic income, like helicopter money, they really became mainstream in 2020. And we know that this is the next stage of our monetary system, probably some sort of the end game. Now, another idea that really got momentum recently is central bank digital currencies. The ECB is looking very seriously at the creation of a digital euro, Madame Lagarde just said. The Federal Reserve is actively working on a digital dollar. Rumors say that if you want to get any government subsidies, you will have to have a digital wallet. And this is probably the most important study that I read over the last couple of weeks. It's by the Bank for International Settlements, the central bank of central banks. And all the major central banks are involved in this study. It is called Central Bank Digital Currencies, Foundational Principles and Core Features. And it's a collaboration between the Bank of Canada, ECB, Bank of Japan, Swiss National Bank, Bank of England, and the Federal Reserve. And this is really something, ladies and gentlemen, that you should be aware of. You should also read the article by Kenneth Rogoff, a very, very influential economist. It's called the case for deeply negative rates. And from my point of view, central bank digital currencies that have nothing to do with real cryptocurrencies, and especially Bitcoin, are some sort of a Trojan horse for deeply negative rates. Now, people often ask me, if we should get the vaccine, will this trigger a big sell-off in gold? From my point of view, it is quite the opposite, because what we're seeing now at the moment, ladies and gentlemen, is uncertainty. Businesses don't make any big capital investments. People don't travel. They're not really planning any bigger investments. But once we have the vaccine, all this uncertainty will be being priced out. People will become more positive. There will be a light at the end of the tunnel. Now, the main problem recently has been that the velocity of money, or as the Austrian school calls it, the demand to hold money, has collapsed because there is no confidence in markets. If we should get this vaccine, from my point of view, this will be a fork in the road for central bankers, because then velocity will start rising, and it can rise pretty quickly, and it will meet an enormous amount of liquidity that was created over the last couple of months. So actually, at this point, central bankers would have to become more hawkish. Do I think this is going to happen? No way. So from my point of view, this will be the point in time when inflation really becomes a big concern. Now, the second road that I would like to travel with you is the fact that gold is still largely underowned. This is a slide or a graph from my dear friend Shane McGuire. He calculated the position of gold in the world's largest funds, so for institutional investors. And at the moment, it is 0.15%. So basically nothing. For investments in general, the gold allocation at the moment is 0.5%. So a bit higher, but still lots of room. And what we're seeing at the moment is that some big names like Ray Dalio, like Sam Zell, are entering the market. Jeffrey Gundlach is becoming extremely bullish on gold. And the main driver going forward will be negative real interest rates. This is one of the most important slides that I show people that don't have a clue about gold. It shows the level of real interest rates and the price of gold. In the 1970s, a huge bull market showed primarily negative real rates. Then in the 1980s and 1990s, we saw primarily positive real rates. So the opportunity costs for holding gold were high. And then since the year 2002, 2003, we're seeing primarily negative real rates, which is the foundation for this bull market. Now, more recently, we saw a very tight correlation between gold and 5-year tips. Now, how is it going to develop going forward? First of all, we will see low nominal rates until at least 2023. Jay Powell said, we're not thinking about raising rates. We're not even thinking about raising rates. And the second big thing is the fact that the Fed went to average inflation targeting. That happened over the summer when everybody was probably taking a time out or a time off from the whole COVID mess, hitting the beach. But in August, one of the biggest shifts in Federal Reserve policy happened. So now 2% is not the ceiling. 2% is the target on average. And as inflation has been undershooting, the Federal Reserve wants to see inflation overshooting over the next couple of years. So this, ladies and gentlemen, is the recipe for negative real rates for the next years to come, which is the perfect environment for gold. And we're seeing that at the moment, 12 trillion are invested in negative yielding bonds. What is the biggest threat, the biggest enemy to those bonds? Of course, it is inflation. So once inflation really becomes a concern, and we're currently writing a big special report on inflation and the resurgence of inflation. Once this happens, I think there will be an exodus out of the bond market. Will it go to real estate? Perhaps. Will it go into equities? Perhaps. But will it go into the most reliable inflation hedge that we're having over the last couple of decades, even centuries, which is gold? Yes. So I think gold will be the primary beneficiary of inflation. And institutional investors are now joining the party. This is really something that I experienced this year. Generalists are coming into the market. This is not the market like we saw it 2 or 3 years ago, where only diehard contrarians bought gold. Now there's really large institutional investors joining the party. We had, for example, Goldman Sachs buying the Perth Mint physical gold ETF. As I've said, we saw Ray Dalio, Sam Zell, many high-profile investors coming into the market. And then we also have this gentleman, Warren Buffett, who said gold gets dug out of the ground in Africa or someplace. Then we melt it down, dig another hole, bury it again, and pay people to stand around guarding it. It has no utility. Anyone watching from Mars would be scratching their heads. And his colleague, Charlie Munger, even said, civilized people don't buy gold. Well, I attend many gold conferences and I see very civilized people. And I think that Warren Buffett also learned more about gold quite recently. So Berkshire Hathaway joined the gold rush and he was buying a stake in Barrick Gold. He is seeing tremendous amount of value on the balance sheets of mining companies. And I think, ladies and gentlemen, it is very important to say that Buffett was selling stakes in financial companies like Wells Fargo, like JP Morgan, like Goldman, and he was getting into the mining space. So he's selling financial assets and he's going into real assets. Very, very important development. Now let's go to the third road. It's about mining stocks and silver. David Brown said, never be the first to arrive at a party or the last to go home, and never be both. Now, when it comes to mining stocks, they're not only cheap on a relative basis to equity markets, they're also cheap on an absolute basis. And measured against gold, they're even cheaper. At the moment, we are trading way below the long-term median. What you can see on this chart is the Bgmi to gold ratio. And we're seeing that it recovered a bit, that we've seen the lows at the end of 2015, but this bull market is really just getting started. And this is what you can see on this chart as well. One of my favorite charts that shows all bull markets in the mining space since the 1940s. And you can see that's the red line. Well, of course, this bull market in the mining stocks is going for a while, but it is actually clear that this party has gotten started, but it didn't go wild. So normally at the end of the trend, you see this acceleration phase, this parabolic phase, and we're still far away from that, it seems. And I always said it's first gold that moves, then it's silver, and then it's commodities. Have a look at commodity charts, copper prices, base metals in general. Have a look at energy markets. Have a look at agricultural commodities. Quite a lot happened. And we're still trading relative to the equity market at valuations that are ridiculous. Basically at the same levels like in the 1960s or 1970s. So commodities are definitely extremely undervalued at the moment and still very, very much of a contrarian position that you can take. When it comes to silver, silver is also still very cheap, especially relative to gold. Ladies and gentlemen, in the 14-year history of the In Gold We Trust report, for the very first time, we had a special chapter on silver that is really worth reading, because we were analyzing the supply-demand imbalances. When we published the report, the gold-silver ratio was actually at 125, which is an all-time high. Now we're trading at roughly 80. Within the course of the gold bull market, this ratio should come down significantly. Where can it go? Well, at the moment, we're still somewhere here with the gold price at 1800 and the gold silver ratio between 75 and 100. It can go over the course of the gold bull market somewhere here. So, you can dream about it, but there's lots of fact that the supply demand imbalances for the price of silver will continue to favor silver over the next couple of years. Now, where will gold go to? Quo vadis aurum? All roads lead to gold. I borrowed this title from my dear colleague Kirill Sokolov, one of the brightest minds out there. In our In Gold We Trust report 2020, for the first time, we had a valuation model. And we said at the end of this decade, we might reach the conservative target of $4,800. Now, that sounds like quite a lot, but that's an annual growth rate of 10%. Now, ladies and gentlemen, if inflation should become a concern, do you think that 4,800 is really such a bullish scenario? I don't think so. And in the report on page 345, you can read all the details of our valuation model. Now I'm coming already to the finishing line. Our central convictions. Sorry, it's not COVID. The coronavirus is the accelerator of the overdue recession that heralds the dawn of a new monetary world order. After the COVID crisis comes the debt crisis. Rising price inflation is not a tail risk, ladies and gentlemen. Negative real rates are the new normal for investors. The renaissance of gold in institutional portfolios has just started and will be one of the main triggers, one of the main catalysts for this bull market. And mining stocks and commodities will be major beneficiaries and are still largely underowned, even though they started moving. But most of the people, most of the market participants, especially the generalists, have not really recognized this bull market yet. So gold, miners, and Bitcoin are on the way to many, many new all-time highs. And going forward, I look forward to explain you where we are on this road. And now I would like to come back to our holiday in Rome. We enjoyed ourselves. We had a fantastic time, especially, a couple of days without the kids. It feels good sometimes. But we needed more people. The city was empty. It was a bit underwhelming. We were waiting for the atmosphere, the excitement, and the genuine Italian spirit of Rome. But for gold, this bus is coming. We should all be part of this endeavor. So don't miss out, and believe me, all roads lead to gold. Thank you very much for your attention. I very much enjoyed it, and I hope that you did as well. Thank you very much.